Hi, welcome back to BoxHero's YouTube channel. Today, we'll be taking a look at inventory and accounting, which may seem unrelated at first. However, both are critical components of any business and are inherently linked. I'll be breaking down some key terms and going over the importance of inventory accounting in this video. So let's get started. First, a little intro into accounting. A balance sheet is a fundamental financial statement, and it can be summed up neatly into this one equation. Assets equals liabilities plus equity. Taking a closer look, a company's total assets are composed of its current assets and non-current assets. This depends on how liquid an account is. For example, property, plant, and equipment, or PP&E, is not liquid, so it's considered non-current assets. On the other hand, inventory is a current asset since businesses typically try to sell their finished goods within a short period of time, usually less than a year. So let's go into the details. Inventory should be physically counted before being put on a balance sheet that we just talked about. Items are listed by the price at which the goods were purchased, not at the price the goods are selling for. This is tied to another term called COGS, or cost of goods sold. Basically, it refers to all costs associated with the business's production process, including the raw materials needed to manufacture those goods. COGS is the value of all inventory goods sold within a given period. There are three main methods to account for the value of stock. 1. FIFO, 2. LIFO, and 3. Weighted average costing. Let's start with FIFO. First in, first out. In this method, the stock that was first purchased for inventory is the first stock to be sold, even if it is physically not. FIFO is used by most businesses, especially ones with perishable inventory, since it provides an accurate depiction of ending inventory and value. Next is LIFO, last in, first out. In LIFO, the last stock added to inventory is the first to be sold. At the end of the accounting period, the inventory left over is the oldest purchased goods. And last but not least, the weighted average cost, or WAC. In this method, the overall value of inventory is based on the average cost of items purchased and sold within a given period. It's not the best for businesses and industries dealing with a lot of price fluctuations in a given time, since significant price differences will skew calculations in evaluating inventory. Just a couple of things to note on inventory accounting. First, inventory does not equal equipment and supplies purchased to run a business like work tools, vehicles, and stationery. These should be recorded as expenses instead. And 2, since COGS and net income are calculated using inventory balance, all businesses must report their inventory. While the stock itself is not income, the value of the inventory is required for determining income. As you can see, efficient inventory accounting is the backbone of a successful business. Advancements in technology have replaced traditional manual tracking, and SaaS platforms like BoxHero are here to help. Check out our website to get access to all the unique features to manage your inventory and get access to accounting and business insights.